Hello, and welcome to the KOD Knowledge Series. I'm Paul Pashy. Today, I'm presenting Volume 3 in Keeping in Touch with Legal Updates. Today's topic is Average Weekly Wage. Don't miss the details. I'm happy you've joined us today, but please note that today's presentation is intended for educational purposes and is not intended to constitute legal advice. Before we go into today's presentation, we wanted to provide a brief update on procedures at the Illinois Workers' Compensation Commission during the pandemic. As many of you are aware, the chairman of the commission canceled all in-person hearings during the month of November and extended this through the month of December or through the end of the year. While web-based conferences and hearings continue, we have not received any update on live or in-person hearings at this time, but expect to have those by the end of this month. If you would like further updates, please contact any of the attorneys here at Nell O'Connor and Danielowitz. So moving on to average weekly wage. Ferris Bueller once wisely quipped, "Life moves pretty fast. If you don't stop and look around once in a while, you might miss it." The same applies to average weekly wage. While many of us are familiar with the basic formula, each case has its own unique facts, and if we don't stop once in a while and look at them, we may miss opportunities to reduce the average weekly wage and reduce the overall exposure for a case. So let's look at what the average weekly wage is and some of the things we can do in our investigation and calculation to help make sure that we are mitigating our loss in the best possible way. The average weekly wage is defined by Section 10 of the Workers' Compensation Act, which states that the basis for computing the compensation under the Act shall be computed as the average weekly wage, which shall mean the actual earnings of the employee in the employment in which he or she was working at the time of injury during the 52 weeks ending with the last day of the employee's last full pay period immediately preceding the date of injury, excluding overtime and bonus, divided by 52. However, if the employee lost 5 or more days, then the total earnings are divided by the number of weeks and parts thereof remaining after the time so lost has been deducted. And similarly, if the total employment lasted for less than 52 weeks prior to the accident, then the method of weeks and parts thereof shall be followed. There are additional rules for short or casual employment, and regard shall be had in those cases for the average weekly wage of a similar employee, and we will talk about that in a moment. There are also rules for volunteer fire, police, and civil defense members, and there are rules for concurrent employment, and we will discuss those in a moment as well. The best way to mitigate a claim using the average weekly wage issue is in how the initial investigation is conducted. The first thing that needs to be obtained is basic information, including the claimant's employment or job at the time of injury, the first date the employee worked, the number of hours that constitute the employee's workday, the number of days constituting a work week, and whether or not there's a written contract that controls the employment terms, such as a union collective bargaining agreement. Once that information has been gathered, then the following factors should be considered when calculating the actual earnings. The obvious one is what are the claimant's regular wages or salary. In the case of volunteer firemen, police, or civil defense members, you would use the wages from the claimant's regular employment. In addition to the regular wages, there are certain things that are included: vacation pay, retroactive raises that became effective with regard to the period that's being used for the average weekly wage calculation, and certain per diem expenses. If the expenses are paid in a lump sum without regard to the actual expenses incurred by the claimant, then those constitute a part of the regular earnings. In addition, tips are included. There are also some items that are excluded from the calculation. Going back to the per diem expenses, if the employee is simply reimbursed for actual expenses incurred, then these are excluded as they do not constitute earnings, but rather reimbursement. In addition, unemployment compensation and other fringe benefits are excluded. And there is also an exclusion for wages when a claimant changes job positions or titles during the 52 weeks prior to the accident. The classic example is where an employee begins as a part-time or lower classification employee and receives a promotion or an upgrade to full-time, and the wages change with the change in job title. In that circumstance, only the wages used in the job the claimant was working at the time of injury would be included. And as we will discover during the discussion of weeks and parts thereof, only the time period that the claimant was in the current job will be used. Once the actual earnings have been established, the next factor to look at are the pay periods. And in order to determine that, the first thing we need to look at are the number of days or weeks in a pay period. The number of days is critical as this will be involved in the ultimate calculation. In addition, it's important to know the last day of the last pay period that was worked prior to the date of accident to make sure that we exclude any earnings that may skew the average weekly wage if they were earned after the date of injury or even in the period of the date of injury, as many claimants work fewer hours following a reported injury. The last factor to consider is the claimant's work calendar and whether or not the claimant expected to work continuously throughout the year, whether the employment was seasonal, whether the employment was intermittent based on factors such as work availability, etc. After determining the pay periods, the next factor is overtime. While the Act says that overtime is excluded, the Illinois courts have carved out an exception for that exclusion based upon whether the overtime worked was mandatory versus voluntary. If the claimant was subject to termination or discipline for refusing to work overtime, then the courts have held that this should be included as part of the regular wages because it was a regular condition of employment. On the bright side, the court does also state that those overtime hours are included at the straight regular hourly rate, not with any premiums such as time and a half, double time, and so forth. A number of cases in years gone by discuss the concept of regularly worked overtime. But in the Edward Don Company case, the court clarified that the designation of regular work or regular overtime is not the controlling factor. Rather, the controlling factor is whether or not the overtime work, even if done the same number of hours per week, is mandatory as opposed to voluntary. And again, mandatory overtime would be included at the straight hourly rate. A third factor to consider is for seasonal employees, there is a long-standing precedent that for seasonal employees, whether the overtime was mandatory or voluntary, the overtime hours are excluded from the calculation, but keep in mind that the number of weeks actually worked will be used in the computation, which will offset the impact somewhat of excluding those overtime hours. The next factor to look at is bonus. Again, the Act's blanket exclusion of bonus has been modified by some court decisions. The types of bonuses that are clearly excluded are fringe benefits, meals, and housing. The issue comes when determining whether a bonus of compensation is based on incentive or production, or is simply a gift from the employer to the employee. For incentive bonuses, which are based upon the employee meeting a goal or incentive during the course of employment and then receiving a bonus, or for a production bonus, which would be an example would include a claimant who produces a certain number of products or produces a certain number of income for the company during a period of time. Both of those are considered as part of actual earnings because they are compensation for work performed, in this case, the work of achieving the goals that were set as a condition to earn the bonus. On the other hand, gratuitous bonuses, such as a Christmas bonus or a holiday gift, would not be included in the average weekly wage. After we've looked at overtime and bonuses, the next factor to consider is concurrent employment. And the general rule is that concurrent wages will be included as part of the actual earnings, but before that happens, a few conditions must be met. First of all, the claimant must have provided notice of the concurrent employment to the employer prior to the date of accident. So when investigating this, the factors to consider are whether the notice was verbal versus written. And written notice can occur in the form of the claimant's job application or in the form of correspondence such as emails or letters to the employer notifying the employer that the claimant had another job that was being worked at the same time. Which leads to the next factor: what constitutes concurrent? The classic definition is that the claimant is working both jobs simultaneously. In other words, working the two jobs or more jobs on the same days, the same weeks during the year prior to the date of accident. The court has held that layoffs can have an impact on this. If a worker is laid off by the insured employer and works another job before returning to the insured employer to work for another period of time leading up to the date of injury, then the earnings from that second job would be considered concurrent, even though the claimant was only working one job at a time, because the court considers the employment with the original employer to be ongoing during the period of the layoff. On the other hand, if a claimant is laid off from a second job prior to commencing employment with the insured employer and never returns to his prior employer during the time he was employed by the insured employer, then the employment with the other employer is not considered concurrent. Another exclusion from concurrent employment would be self-employment wages. Some examples of these would include cases involving claimants who gave piano lessons or other services out of their home while working a full-time job for an insured employer. And the courts have held that the tax returns or other documents filed for running such a personal business are not acceptable as proof of concurrent employment. So this leads us back to the calculation methods for average weekly wage. The first method is the easiest one, where we have one employment that existed for over 52 weeks prior to the date of injury. Then you simply take the total earnings and divide them by 52 to arrive at the average weekly wage. The second method refers to those types of employment where either the employee missed 5 or more days during the year or where the total employment period was less than 52 weeks prior to the date of accident. Before automatically deducting all those days, though, an inquiry needs to be made as to what the reason was for the absence. If the absence was to the extent not due to the fault of the employee, then those days are not treated as absences for purposes of the average weekly wage. In other words, those days would be deducted as weeks and parts thereof. Some examples include work canceled due to weather conditions or time missed while caring for a critically ill family member. On the other hand, if the reason was due to the fault of the employee, for example, time taken off for medical leave or time taken off for non-paid vacation, those days would not be deducted from the calculation. In computing the weeks and parts thereof, then we have to look at the number of hours in a typical work day and the number of days in a typical work week. While most employment involves 8-hour work days and 5-day work weeks, not every employment situation is the same. So those numbers should be determined before calculating the average weekly wage. Once that's known, then to determine the number of weeks or parts thereof, the number of hours worked would be divided for each day by the number of days in a typical work day. So for example, if it was an 8-hour day and the person worked under 8 hours, it would still constitute one day. But if the person worked 5 days a week and worked less than 40 hours, then you would divide the total hours for the week by the hours for the typical workday to achieve the part of the week. In our example, for an 8-hour workday and a 5-day work week, you would take the total number of hours, say 32, and divide that by the expected hours per week of 40 to arrive at 0.8 weeks as the parts thereof of that week worked. Calculation method number 3, which involves the person whose employment extended for less than 52 calendar weeks, would use the exact same method for weeks and parts thereof. Calculation method number 4 applies to situations where the claimant did not work for a long enough period of time to generate sufficient data to do these calculations. And in those cases, consideration is supposed to be had for a similar employee. The key factors in identifying the similar employee are the employee's grade, whether the similar employee is doing the same job duties or work as the injured employee. And again, the number of hours per week needs to be identified and the number of days per week needs to be identified, and either methods 1, 2, or 3 applied to the similar employee's wages to determine the average weekly wage for the claimant. Unlike the primary claimant, though, when using similar employees' wages, there is no requirement to consider overtime hours that were not actually worked by the claimant. So the question is not whether the overtime was mandatory for the similar employee, but whether overtime was mandatory for the injured employee and whether the injured employee actually worked any overtime prior to the date of injury. The last consideration of factors is the issue of concurrent employment. And the simple formula for that is to separately calculate the average weekly wage for each employer and then add up the resulting average weekly wages. So for example, if you have a claimant who worked the entire 52 weeks for both employers, you would use method 1 for both employers, dividing the actual earnings by 52 weeks and then adding the 2 average weekly wages to come up with the total average weekly wage for your claim. If the claimant missed 5 or more days or did not work for the entire year for either of the employers, then you may have to do a separate calculation for that employer using method 2 or 3 or even 4, and then perform an individual calculation based on the appropriate factors for the second employment, and then add the 2 results together. The key here is investigation. And the more you know about the claimant's work conditions, the terms of employment, and the period of employment, the more accurate you can be in calculating the actual earnings, excluding appropriate portions of the payments received by the claimant, and accurately determining the number of weeks that are used to divide into the actual earnings to determine the average weekly wage. And the more attention that is paid to this detail, the more likely you will be to achieve the correct average weekly wage and mitigate your loss. We hope you enjoyed today's topic. The defense of any workers' compensation or liability case requires a careful, detailed evaluation of the facts and the law. For a free, confidential assessment of your claim, please contact us anytime, and we will be happy to provide our insights and recommendations. Again, all consultations are confidential. Thank you for listening, and we'll see you at the next webinar.